where does the Aussie go from here? We have the RBA saying that the Aussie dollar is just a little below peak of the past couple of years. We know that the Aussie has been pretty much supported by the dollar, iron ore prices, the broader market sentiment as well. What's your take on where the Aussie is headed?
It's certainly, so our forecast is that it sits around sort of the mid-70s level as we look over the next sort of 6 months or so. Now, you know, that sort of trading range between the sort of 70 to 75, we believe holds for a couple of key reasons. Firstly, yes, the recovery in growth and so forth is generally positive for the Aussie dollar, and also we expect a weaker US dollar over that period to lift that Aussie closer to around the mid-70s. But the couple of caveats I'd put on it, Haslinda, is this. First point is we actually expect the iron ore market, or the proxy to Aussie terms of trade, we expect iron ore prices to begin to move lower into the end of the year and into the middle of 2021. That puts a bit of a ceiling on the Aussie dollar moving above that sort of 75 level. The second point I would make is that a lot of what goes on between the Aussie dollar and the US dollar is largely going to be determined by the interest rate spread between Australia and the US. Now, that spread was deeply negative before COVID, and then it moved to being positive post-COVID-19, and it's maintained that positive premium to US rates. So the consequence to the RBA moving buying government bonds out a little bit further along the curve is to keep the rates curve on a flatter bias. And so the consequence of that is it's likely that the interest rate spread is going to head back down towards that sort of 10 basis points to around zero. So the consequence of that as well is that that's a bit of a headwind for the Aussie. So we actually think that most of the movement in the Aussie dollar will come from the weakness in the US dollar rather than these sort of cross currents that we're seeing at a domestic level.
And it seems like with this budget, they're looking at something more of front-loading some of this infrastructure spending, Wayne. Does that actually help the commodity sector in any way? I mean, we've seen the asset class overall been hit by this fear of a second wave, also this demand concerns. How are you viewing commodities now?
Yeah, so just to break that up into a couple of bits, the first bit I would say is with respect to the increase in infrastructure spending, that what it will naturally do, and also as well as you put more monies in household pockets, you would expect a pickup in imports. And so the current account surplus has been at periods at record levels. We actually expect the current account surplus to begin to head back into a very small negative as we go into next year, largely because iron ore prices coming down and commodity exports still remaining robust, but prices coming down a little bit, see a bit of compression on the export side, and at the same time, imports are picking up. So generally speaking, as we drift back into current account deficit, that tends to put a bit of a headwind in front of the Aussie dollar. Having said that, though, from a broader commodity sector perspective, clearly the focus is still on China and how infrastructure spending in China, as well as the amount of support that they provide their economy, and the need for a pickup in global exports or global trade now to give China that next boost. And so from that perspective, we're actually quite, even though we see iron ore prices softening over the next 6 months or so, we actually see, for example, oil prices hitting $55 by the time we get into the middle of next year, copper prices rising a little bit further from here, and also agriculture has been delivering very positive returns. So when we look across the commodity space more generally, we actually expect more gains on the commodity side. We have commodities as our most preferred in our asset allocation. We expect more gains there, but nonetheless, iron ore prices in particular should come under some pressure. Of course, coal prices have been very weak, but we do expect coal prices can rebound a little bit as global growth picks up. So net, terms of trade comes down a bit. Current account drifts back into the sort of the deficit area. That puts a little bit of a headwind on the Aussie dollar from that perspective.
And when you mentioned about oil, I mean, we've seen Brent, though, it's remained firmly in contango for most of the year. So do you think that the markets can actually absorb the signals of oversupply, especially if OPEC Plus may add another 2 million barrels a day starting early next year?
I think think that the current issue in the oil market, I think, is mostly related to the uncertainty around the demand side. And a lot of that uncertainty around the demand side is broadly based around the pickup in cases we've seen of COVID-19 in some European countries where they've extended a little bit of those restrictions again. And so that's created a bit of uncertainty around when we can get back travelling again, what the broader demand side picture looks like. We've actually recovered quite a bit of what we lost on the demand side. We went into COVID-19 at around 100.5 million barrels per day. We're now around the sort of 94, 95 million barrels per day of demand. And we got down to as low as the low 80 million barrels per day of demand at the peak of the crisis. So we have actually recovered quite a bit. But the restraint on the OPEC side gives us some comfort, particularly given the fact that we have seen a little bit of in and out on some compliance from some countries. But generally speaking, the OPEC Plus group, the compliance levels are very, very high and actually continue to slightly improve. So from the supply side, we're pretty comfortable that US production is going to dip back to around 11.5 million barrels per day. It was about 13 million barrels per day or so before the crisis. So there's definitely less supply coming from the US, and OPEC compliance has been very good. So the supply side to us remains very much a supporter of higher prices as we go into next year, particularly as we expect to get a vaccine more broadly available in the second quarter of next year, which would start to see demand and confidence in demand begin to recover more fully. As well as that, obviously, a weaker US dollar tends to be positive for commodities overall.
Wayne, we have time for just one final question. We have to touch on gold. Where will gold peak this year? Okay, well, of course, gold prices have set back for all the reasons we would expect it to. Real interest rates have ticked up a little bit. They're trading around the negative 1%, 0.9% at the 10-year tips level. They did get down to below 1.1, negative 1.1%. That was at the peak of gold. The key for me with gold going forward is twofold. Firstly, the mixed messages we're getting from the Federal Reserve, they begin to become more fully on the dovish side. The key issue was post-Jackson Hole, while they did announce the average inflation targeting, unfortunately since then there's been a number of mixed messages coming from Fed members with respect to how much more on the QE side they're actually going to do. That's one first key point. Second key point is the outcome for the election, the US election. Of course, we've been fooled by the polls before, so there is a lot of uncertainty around that time. We think that the uncertainty from that event, we think that negative real interest rates dipping deeper into negative territory as we go into next year, getting back to that sort of negative 1.2% on the US 10-year tips, and also the dollar weakening a little bit as we get more confidence that emerging market growth can pick up, particularly with a broader application of the COVID vaccine in second quarter next year. So those factors to us mean that inflation expectations, so the Fed will defend inflation expectations, they will begin to rise again, potentially hitting above 2%. That will force real interest rates in negative territory, and that can lift gold back to around the $2,000 an ounce. Gold is still an excellent diversifier, though, within the portfolio context for people wishing to hedge against these uncertainties we have coming towards us.